You know the saying, give someone a fish and they can eat for a day, but teach them to fish and they can eat for a lifetime? Well, here at Charles Stanley, we want you to learn how to fish, and we're teaching you with the best fishermen out there. So with this in mind, join me as I learn about different fund sectors as taught to me by investment experts who actually run them. I'm talking about the big dogs here. For inspiration, our direct investment service preferred list can be a great place to start. Compiled by our experts here at Charles Stanley, designed to provide a helpful short list of fund options to choose from. But we want to take this one step further. So each month, we're going to be learning about different fund sectors, giving you the educational tools that you need to make good, informed investment decisions. We'll be taught about each of these investment areas, what factors to keep in mind, stock market considerations, the impact of current events, cause for concern, and tons of stuff in between. Before we introduce this month's guest, if you're liking what you're hearing, please do go ahead and like, share, subscribe to our videos, engage with us in any way that you see fit. So today we'll be learning about the global emerging markets sector. We're going to be joined by Emily Fletcher, emerging market fund manager at Blackrock, alongside familiar face here, Chris Ainscough, our director of asset management here at Charles Stanley. Let's check it out. Emily, Chris, thank you both so much for joining me here today. Chris, I'm going to kick this off with you. Let's talk about the global emerging markets sector. What does it include and what's it all about?
It's pretty broad, and geographically it's probably the broadest we're going to be discussing. You've got the big names, you're looking at sort of your Chinas, your Indias in there, but then we can move through Brazil, South Africa, Saudi Arabia, all the way across to sort of Indonesia and Vietnam. So across the globe, you're covering a big spread, and within that, there's sectors in all areas really. So you do have a ripe hunting ground for stocks. And I think one thing is China is quite a large component. If you're looking at global, that can be up to a third of your index, depending on what you're looking at. So you just got to be cautious of where you're going to be investing within that and whether you want to take a more regional play or pick something more diverse.
So Emily, can you please explain the difference between an emerging market, which is just kind of the general area, and a frontier market, which is much more specific? What's the difference between the two of them?
Yeah, sure. Actually, I think it's almost more interesting to explain the difference between a developed market and emerging market. A developed market is really about the development of a country's index and development of their trading facilities, development of sort of things that you can do on those index in terms of options, derivatives, currency trading, things like that. And that's where emerging markets are different because their countries' indices, stock exchanges are generally much less developed. And frontier markets, then you take a further step down from that. So you'll have less liquidity, less development, but it's not about whether or not a country is rich, for example. So Qatar probably has the highest GDP per capita of anywhere in the world, and it's an emerging market. Somewhere like South Korea probably has the highest level of tech development of anywhere in the world. It's an emerging market. So it's not about, and I think a real misperception is that it's about a level of development of the country, and it's not. It's really about the development of your ability to sort of trade within those countries.
So Emily, to many people, emerging markets means China, India, and that's pretty much it. As a fund manager in this space yourself, what do you make of that?
Yeah, thanks. It's a really interesting question. But I think for me, it's a little bit like saying the only thing in England is London, or to say that, the only cricketer that England has is Ben Stokes. I mean, they are both fantastic, both really important, but there is a whole variety of assets out there outside of all of that. So as Chris said, it's about 50% of emerging markets. That leaves the rest of the 50%. And actually, I think some of those smaller markets can end up being really interesting because people pay them much less attention.
So when considering frontier markets, I can't help but think about the risks. Emily, I'm sure you get this question a lot. I'm thinking about things like governance, political unrest, solvency issues. What kind of things do you evaluate when looking at different areas?
Yeah, sure. I think it's a really, really important question to be thinking about. And for us, when you come down to the smaller emerging market and frontier market end, although you could have single country funds, we actually think that it's quite risky to be looking at the single country fund at that level. And we really like to have a diversified approach in these smaller emerging and frontier markets. And where we invest in our frontier markets fund is both smaller emerging and frontier markets. I think it's really important to have that diversification globally. So we've said we wouldn't generally have more than 15 to 20% in a single country. And that's because on any given day, you could wake up, there could have been a coup, the market could be down 30%. Yeah. If you have 15% of your fund in that country, that means you will have lost 5%. That's really painful, but at the aggregate level, your fund is still there. Yeah. And so at that level of diversification is really important. I think the thing that offsets a little bit some of the risks is that what happens in these countries actually often has very little impact on what's happening in some of these other countries. So, we have Kazakhstan, for example, and what's going on in the politics, the macro there, will have almost no impact on what's going on the politics, the macro in Chile, which will have no impact on Nigeria, which will have no impact on Indonesia. So that actually does give you some real benefit of diversification as well. And that it's much less impact on each other than you would see in the developed world, where economic political cycles tend to be much more homogeneous. And then I think the final bit that's important for me to add is that we wouldn't invest in a company that doesn't have fully audited results. Those results are typically audited by a subsidiary of the Big Four, even in the markets that we look at. And we will have met the companies that we invest in probably at least sort of 5 times before we invest. And we've traveled to the country, we've met the companies, suppliers, competitors, political experts, everything we can around that. And that level of due diligence does really help. But it's something we really need to be aware of.
So Chris, back to you here. There's a belief that demographics are the determiner of a country's performance in the stock market, with lots of eyes on the previously mentioned India and China to eclipse the Western world as their populations do continue to climb. What are your thoughts on this? Does population automatically equal a robust economy? What do you think?
Yeah, I think it's really interesting, and it's sort of an argument that's been rolled out for many years around that sort of maybe either an emerging middle class, in some areas, the youth of the population and how that might feed through. I'll probably split the question in 2, but then maybe answer both as a no. So it'd be interesting to get Emily's takes afterwards on this. I think in the short term, demographics really are a multi-decade phenomenon. So short-term movements are very unlikely to be driven by demographics. It can provide a great backdrop for the companies operating in those countries, but things that are moving markets on a month-by-month, year-by-year basis are very unlikely to be related to that. Over the long term, saying that, I think demographics are positive for a region. If you do have positive demographics, it gives you that workforce, hopefully the upskilling of that workforce as time progresses. But there's quite a number of leaps to get from positive demographics to maybe strong GDP growth in a region, to strong earnings for those countries, and then maybe investment returns on the back of that. So I think there's plenty of reasons to invest in emerging markets and frontiers. Demographics might be a additional one on sort of layered on top, but it wouldn't be the reason I went there in its sort of entirety behind that. So we're very interested in someone that follows the region much more closely to see whether that's a take that you take or.
Yeah, Emily, what do you think? Does population equal a robust economy?
I would say absolutely not.
Yeah.
I think that there's been, again, sort of a real kind of mis-selling historically in emerging markets, in that being, the reason why you should be interested in emerging markets. I would say completely the opposite. Emerging markets is really interesting as an active investor because of the dispersion, the volatility that we see in these markets. And that means that you get opportunities every year. I think emerging markets are interesting because, as I said, they're heterogeneous. Different bits are going up at different times. That's what I think really makes emerging and frontier markets extremely interesting to work in.
So Chris, what percentage of your portfolio do you think should be allocated to this sector?
Yeah, I'm going to open with a big caveat. It's around your risk appetite and tolerance to risk. There are substantial risks within this region, but that does give a lot of opportunity, and it's making sure you're getting rewarded for those risks in your allocations. I think we have to look at things. Russia was in this index not long ago. It got taken out at 0 value. That can happen.
Ouch.
So it is an area where you probably do want some boots on the ground and things that Emily's been talking about there. If you want to, you can allocate more regionally. You could pick a LATAM fund, an emerging Asia fund or the likes, or you leave that flexibility with someone else to rotate around those regions and find the areas of value within it. On our side, we do allocate everywhere from sort of a medium-low risk upwards, and you're hitting double digits by the time you're in those high-risk solutions. But that is making sure that you are getting compensated for that and you're able to wear that volatility if you need to.
So Emily, when it comes to your fund, what is your general investment strategy? What little bits can you share with us?
I think, as Chris was talking about the risks, taking risk is a really important part of what we do as investment professionals. And it's about making sure those risks are deliberate, diversified and scaled, that you are taking them where you think you're taking them and you're taking them really in an appropriate way for the fund that you have. So, we think we have a strategy that's really compelling and really interesting on a 3 to 5 year time horizon for people who are able to hold it for that duration. And on that basis, we think it's really attractive at the moment, given valuations.
Fabulous. Emily, Chris, thank you both so much for being here today. And thank you to all of you for watching.